Hello, good evening, good morning. My name is Srinivas Kunte. I am the Director for Continuing Education and Advocacy at CFA Institute. Welcome to our webinar series. Today's webinar is on machine learning and fintech. Despite all the buzz on both these words, it is never easy to find a use case that is being run as a successful business venture. So we are fortunate to have with us today a charter holder member who has been running a fast-growing fintech business in India. Today's webinar will cover two main aspects. Number one, the transformation journey of traditional lending to digital lending as a business. Number two, it will also offer practical machine learning features that enabled this transformation. Our speaker for today is Shalabh Singhal. Shalabh currently is leading ZipLoan. ZipLoan is a rapidly growing fintech NBFC which Shalabh co-founded in 2015. Shalabh has founded other companies as well. Prior to being an entrepreneur, Shalabh worked for Goldman Sachs Asset Management. He is a IIT BHU engineer and is a very valued charter holder member. Warm welcome to you, Shalabh. But before we begin, some quick housekeeping notes. We have a hard stop of 1 hour, but we'll try to answer as many questions as possible. I do hope that the questions are on the conceptual side of things. If you have any technical difficulty, please press the help widget. For those who are unable to attend, an archived version of the webinar can be accessed after the event. One final comment before we begin. Our webinar series has a practitioner orientation. We would like to hear from you on topics and speakers you think would add value to you as a member. So do write to us, and also please do fill in the evaluation survey and feedback form that is included on the webinar site. Now let's begin. Over to you, Shalabh.
Yeah, thanks Srinivas, and thanks everybody for joining us this evening. So just to give a quick overview of this webinar, I would begin with discussing the overall size and the key enablers for digital MSME lending in India. MSME as in micro enterprises, and this is the space that we operate in. And post that, my key focus in this webinar is to address how machine learning is helping solve some of the key challenges in building a scalable lending business. I would also explain how predictive models are built, and followed by talking about some popular machine learning models and the challenges while deploying a machine learning strategy in any business. So the idea is to separate buzz of ML and AI and digital lending with the real action happening on the ground with all of this. So if I have to talk about the overall Indian MSME space, there are close to 55 to 60 million micro, small and medium enterprises in India. And just to segment this particular base better, an annual turnover of these businesses is a good criteria. So if we look at the MSME space, it can be further divided into micro, small and medium, where micro businesses are generally businesses with their annual turnover of less than 5 crores. Smalls are the ones with their turnover between 5 to 75 crores, and medium are the businesses with their turnover between 75 to 250 crores. Out of the close to 60 million MSME base, around 96% MSMEs are really the micro MSMEs. And even in the micro, they tend to lie between the nano and mini category, which is businesses with less than 10 lakhs or less than 1 crore kind of a turnover. And this is the segment which is where the real opportunity lies and where there is a real under penetration. And most of the machine learning disruption that is happening right now is helping address this particular segment, which has been largely ignored by most of the banks and financial institutions in India for last 40 years. Moving on to the next slide, just to help establish my point. Study by BCG and Omidyar Networks, which studied the overall MSME credit demand supply gap in India, and they publish a lot of other facts and figures. But the important figure here to look at is that the overall MSME demand as per 2018 market is estimated to be around 45 lakh crores or $600 billion in India. Out of this 45 lakh crore demand, only 15 lakh crores of demand is currently being served by formal institutions like banks and NBFCs, and major amount of that funding is going to SMEs, small or medium enterprises with a turnover of more than 5 crores. And the base of micro enterprises, which is really the 96% of the overall base, is not getting enough benefit from this particular share. Then there is further 20 lakh crore of demand, which is served by informal players like private money lenders, chit fund operators, and some unorganized NBFCs operating in the market, which are charging exorbitant interest rates in the range of 50 to 60%, right? And then there is another 25% of demand which is available, which is currently being served by different means. So there are small businesses which have been taking multiple credit cards just to fund their businesses, and that kind of funding sometimes come at a cost of 36, 40, 45%, right? Again, around these estimates, it's safer to say that there is around $300 to $350 billion worth of demand which exists in the MSME lending space in India. Now, since such a large demand exists, so obviously there should be some valid reasons why a significant demand supply gap has been created over past few decades. And this brings me to the next point of discussing the reasons why banks have not been able to crack this in the past. So some of the key reasons that I would like to talk about here is most of these micro businesses do not have the financial documentation required as per the other products served by the banks. So they might not be having the proper P&L statements, balance sheet documents, business proposals, which are required in larger ticket size loans. So they do not have any customized offers or customized products for them, which can work in absence of these kind of financial documents. Most of these micro businesses have been started by individuals who have migrated from villages or smaller towns, and they do not have any property or collateral to offer. Some of them also are available in a joint family background where they do not want to offer their property as the mortgage. Again, this builds a strong restriction in the kind of products which they can secure from the financial institutions. The third biggest challenge is that a lot of these MSMEs or small businesses are scattered in nature. So unlike a salaried product for a bank or a personal loan product for a bank, where they can source a large number of customers by tying up with a large corporate, all of these SMEs are scattered into different clusters, into different kind of regions, into different kind of industries. So any sourcing strategy, there is no unified sourcing strategy to source them at scale. A related challenge is that a lot of these businesses are into multiple business verticals. Even at Zip Loan, we have funded close to 100 plus different kind of business and industries. So every such business has very different set of peculiarities or challenges, or the kind of credit transactions they would have in the past, the kind of seasonality they would have in the business. And it again becomes difficult for a manual credit score or a manual judgmental model to analyze risk for such kind of businesses. The other challenge is that when we are talking about micro businesses in general, and since they will be eligible only for smaller ticket sizes, if the lender has developed very manual operations where there's a lot of manual intervention is required, it leads to a higher OPEX. And higher OPEX doesn't justify doing a small ticket size loans, right? So it becomes a kind of a vicious circle where just because of that manual intervention, people cannot take small ticket size loans, and since they are not able to get the small ticket size loans, they will never be able to build a track record or credit history for higher ticket size loans. And the last one is that in the past there has been very low experimentation in the absence of the data, since the requirements of the data or financial documents has not changed much. A lot of data on these small businesses was not collected. In the absence of the data, there have been no experiments to open up new customer segments. So for example, if someone has a credit bureau score of less than 700, he might not be eligible for a loan because no financial lender has experimented with such kind of low credit scores. So since the topic of this presentation is also about digital MSME lending and how machine learning is being leveraged by digital MSME lenders, I would first like to describe what is a digital MSME lender and how we can differentiate between a digital lender versus a traditional lender based on some attributes on their operational activities, right? So I've tried to list some key focus areas which either a digital MSME lending should be practicing or someone trying to get into this space should focus on. So one is the automation. Like obviously every industry requires automation, but here whenever someone gets into digital MSME lending, on day one they won't have the necessary data to drive the overall automation, right? Over time, the kind of business intelligence which is captured from the ground serving a particular segment has to be again fed into the system. Some more and more rules have to be built to drive automation on a regular basis. The next important thing is that every customer exchange should be datafied. What I mean here is that as an organization, data should be treated with a lot of sanctity. A lot of data in traditional lending gets generated but is never converted into a machine readable format. So it could be data lying into scanned documents, voice data which when telecallers or sales team or collection teams call the customer and there's a lot of conversation happening on the phones. Then a lot of comments by a different people involved in the process, whether it's credit, collection, sales, operations, get collected into the system, but again either is not logged into the system or is not logged into the system in a structured way, right? So as a digital lender, it is important that every data should be properly sorted and stored into the system so that in future we can do something with it. The third is data should be acquired from multiple sources. One of the limitations why we have not been able to run new experiments, open up new customer segments, or try to able to serve the bottom of the pyramid is because we have limited ourselves to just 2 or 3 data sources, which could be, let's say, financials, which could be credit bureau record. But there is so much of data with respect to web digital footprints, the mobile data which is lying there, that once we start collecting that data, we can find out correlations between that data and the traditional data, and then try to develop surrogate information or variables from the alternate data. The other is the data lake environment. Just to explain what do I mean by data lake is, it's important that as a digital lender you have the data in a very structured format. It could be the structured or unstructured data, but it should be readily available for your data warehousing or your data science teams to experiment on. Again, building a proper data lake environment is a continuous exercise required from the digital lenders. The other point is that whatever data you keep on collecting, you have to run some experiments continuously on this data, because over time, as you grow from a small scale to a mid scale to a large scale business into MSME lending, you will see that by the continuous application of algorithms on the data, your learnings over time will improve. So you should never wait that you will apply certain algorithms, certain approaches only when you have collected a large amount of data. Running some early experiments on the data, however small or unstructured it is, helps you understand what kind of further data needs to be collected, how it need to be sorted. Then coming to the next important point is the controlled business experimentation and the concept of data acquisition at cost. So what I would like to highlight here is that just to give an example from ZipLoan, when we started, we were not doing loans which do not have any credit track record. Over time, we started experiment with 5-10% of our portfolio lending to such customers who didn't have any credit track record at all. And after 6 months, 1 year of experimentation, we found out that this segment was performing as well or better than the segment which had credit bureau track record. But unless you run such certain controlled experiments with a limited amount of capital or a portfolio, you won't be able to develop learning, and it becomes more difficult at a larger scale to run experiments than at a smaller scale. So continuous business experimentation and data acquisition at cost. What I mean is, might be some of your experiments would fail, or you might incur losses in that kind of portfolio, but still running those experiments is important, because it's the fundamental concept of data science. You have to acquire data initially at cost by running some experiments which might or might not be successful. Then the other activity which a digital lender would be doing differently than a traditional lender is that he will be focusing a lot on the customization. So for example, in case of MSME, how you service a trader might be very different than how you service a manufacturer. A manufacturer might be looking for a loan for a capex, but a trader might be looking for a loan just for his working capital requirements. Both of these category of businesses might have different take on the TAT which they require for a turnaround time in which they require the loan, for the tenure for which they want to service a loan, or what kind of yield they might be comfortable with. So having different products for different customer segments again could be derived by using cluster algorithms, which I am going to talk about in the future slides.
Sorry, Shalabh, Shalabh, just one quick question, because I can see that questions coming in this area. Just wanted to understand if you can give a quick application of you mentioned experimentation, right? Some experiments that could fail in data acquisition. Can you give a practical example?
Sure. So just to give you an example, as I said, there are 60 million micro MSMEs in India, right? Now, generally the way products, when I say products, basically loan products are built for this segment. They would say that I need a CIBIL score of let's say more than 700. I would require a 3-year business vintage. I might require 15 lakhs of turnover. Right. So now, out of this 60 million MSMEs, you have suddenly sort of segmented your market or developed a niche only for, let's say, 5 or 10% of the customers. So what are you going to do with the other 95%? In the business, when you are running an NBFC or a bank, you might feel that people coming from the credit background, they would have certain perceptions about a certain segment, that this might not be the right segment to serve. It might have higher defaults. So how do you challenge that, and how do you run some controlled experiments so that you can get the first feedback basis on the data and in the actual performance of the loan, rather than just following the past perception. So here, having an agile system, not just on the data platform, but overall applications which you are using, which can run, which is able to develop and control new experiments, is very essential, right? So at Ziploan, we, with the 5% of our portfolio, the 10% of the portfolio, we're always trying to experiment with the new customer base or new customer segments. So for example, we currently the experiment that we are running is that can we lend to customers which have 5 to 10 lakhs kind of a turnover, right? So that's a nano category of businesses, and how many checks or filters or KYC documents do we require in that particular case? So for such kind of experiments, what we do is we try to cluster the customer base, which is our top funnel, and then defining new products for that particular cluster, running it for 6 months, 1 year, testing their loan performance, and then scaling on that particular segment.
Got it. Okay, sorry, move on. Thank you. Yes, okay. Thank you. Please move on. Thank you.
So, what all, coming to my next slide, disruption by digital MSME lending. So, what all this leads to, all the automation, all the data infrastructure, machine learning that we are doing investment in, what are the major impacts of these activities? First of all, you can significantly reduce your TAT. A typical TAT in servicing a MSME loan today by any traditional lenders is around 2 to 3 weeks, right? This could be significantly reduced to 3 to 4 days, even after doing all the checks or doing much more amount of checks, just on the basis of the automation and the machine learning algorithms. I'll talk about some of such use cases which help us in automating a lot of stuff. The other key metric which is important in this business is the overall OPEX you are incurring in your processes, starting from sourcing till the time of disbursement and then collections. Again, by reducing human dependence, if you can reduce this OPEX, you can pass on these benefits back to the customer and further grow this business. The third is the overall documentation which you require from this customer base. Since these are the actual business owners and they are busy in their business places, some of them do not have this documentation. Using alternate variables which can act as surrogate for the traditional financial information, you would be able to reduce the documentation. And just because you now have a much better automated systems, there is lesser human bias and lesser collusion between your sales team, between the actual borrower. You can expect a much better asset quality. And I've already talked about customer segments. One other important concept is the early warning signals. Typically in a loan or a lending business, your feedback loop is slower, because if you have given a loan only after 1.5 years, 2 years, or in some certain cases after 3-4 years, you will get to know about the real portfolio quality. So using machine learning algorithms to develop early warning signals or early warning signal score on your existing portfolio can give you a much quicker insight into what is going wrong into your portfolio, so that you can again take that feedback back into your systems. So again, this brings me to the next slide, which is key enablers for digital MSME lending ecosystem, because we have talked about that it's a significant problem, and there's a significant supply credit gap which exists in the market. Banks and NBFCs, traditional banks and NBFCs have not been able to address it for a long time. Now, digital MSME lenders are trying to solve some of these challenges. So, this is not just because machine learning has come up recently in the past. There have been a lot of ecosystem level changes which are driving this particular change. So one such change which most of us would be aware would be that the kind of smartphone and penetration that we see in India and the reduction in the overall data cost. Most of the borrowers that we serve today, they have completely leapfrogged. So they have never used desktops or laptops. They have completely leapfrogged directly to the smartphones where they are using emails. They have a lot of digital information available on their phones which could be used for lending. The push by the government on the GST is again acting as a big boon for MSME lenders like us, who because GST provides with a very valuable data like sales, purchase, number of clients, suppliers, etc., which in the past was generally collected on the side by interviewing the customer. This data and the entire GST chain is available through a simple API call today. And then the proliferation of cashless transactions like UPI, IMPS, NEFT, RTGS in India has built a significant digital trail of these businesses over which a lot of transactional level machine learning algorithms can be built. Then the other development which is happening is the increased partnerships between different banks, fintechs, and other service providers who are engaged with MSMEs. So companies like accounting softwares, e-commerce companies where these MSMEs are selling their products, wallet companies, logistics companies who are providing these services, they all are collaborating together and sharing data between themselves, which is again enriching the data for the data science and machine learning practices and help design better products and assess risk for these customers. The other major change is the unbundling of financial services. So earlier, if an NBFC or a lender had to start a business, they would have to develop a lot of core activities or core capabilities on their own, which now have been unbundled, are available at a very cheap APIs integration cost. So services for verification of the customers, eKYC, e-signing of the documents, analyzing of their banking transactions, or these kind of services are available on an API today, and any new digital MSME lender can leverage all of these services and focus on its core business. Moving to my next slide. So now I think we'll go more deeper into machine learning, and I'll start with discussing the problem statements in digital MSME lending. So one of the main or I would say the fundamental thing in machine learning is how you define your problem, because the way you are defining your problem statement also decides the overall approach which you will take in solving that particular problem. So the core problem to be solved using machine learning in digital MSME lending is the credit underwriting. Now there are two use cases here. The first use case is obviously determining the probability of default over your loan tenure period using several kind of inputs data that are available, which might be the transactional data, the credit bureau data, demographics, web footprints data. So for example, some of these businesses might have their profile listed on platforms like Just Dial, Trade India in India, and then from mobile data you might have access to the call logs, contacts data, their location data, which could be used for underwriting. The other machine learning use case is how you price these customers. Basically risk-based credit pricing, and what it means that the overall pricing for the customer should factor in the probability of default, and this ensures that you are serving the competitive pricing in the market, so that your competition is when after assessing a risk for the particular customer, you are offering him the best available price in the market. Again, machine learning is helpful when you combine your credit risk models with the overall risk-based pricing models. You can come up with a competitive pricing. The other important use case is the information retrieval. So in countries like India, where you have a lot of even as a digital lender, you will end up accepting a lot of scanned documents. For example, a scanned bank statement, because that particular business owner might not have been using a net banking facility, or you might accept scanned documents for KYC. In such cases, using machine learning models like neural nets along with OCR might help you parsing information or retrieving information from those documents in real time. So again, this is a big plus for digital lenders, because they would be able to automate a lot of decision making based on this use case. The other use case is that a lot of information might be unstructured. So for example, transactional data, level data of banks, SMS data, comments data, which I discussed earlier, this is unstructured data. So before even feeding this into any kind of predictive model, just retrieving information from the unstructured data again is a machine learning use case, and there are several models and approaches which could be leveraged for parsing this information. Coming to the other important use cases, the most significant is also sales and marketing. There is, as I talked about, that you have to customize your offers for different set of customers. You have to identify and open new customer segments. So this is a clustering use case in machine learning, which I'm going to discuss in more detail in further slides, where the kind of communication, the kind of offer which you are rolling out to a particular customer base can be determined by understanding the key attributes of that particular customer segment. So for example, if there is a customer segment which is a migrant from smaller towns to the current city, you can define a separate kind of offer for them as compared to customers who have been locals of this particular city for a long time. Then when you're building a business at scale, and your sales team might be having a lot of leads on a daily basis, and what you need is a much more refined lead for them, so that they can focus on only those leads which have better chances of conversion. A lot of digital lenders and banks have seen success in building chatbots for handling the queries and customer support. Again, it helps you gathering all data. Your data won't be lost because your chatbot will be able to serve the customer at every point in time, and you can reduce the need of having a lot of sales and support guys, which further helps you in reducing OPEX. Then on the collections front, which is again very important, as I discussed earlier, you can generate early warning signals on loan accounts to predict delinquency much earlier than the actual delinquency happening on the loan account. And once the delinquency has happened, you can also determine what is the loss that we are going to book. So for example, if a particular customer has gone into DPD 30 or days past due 30, has not served his EMI for more than 30 days, you can build models to determine how much this customer has to will write off, and this helps you in understanding the overall loss in your portfolio. Coming to the next slide, which is the machine learning. So I'll be able to give you a overall step-by-step process of building the machine learning or predictive models. This means that it starts with obtaining raw data, cleaning the data, visualizing data, labeling the sample data, and then modeling it. And adherence to a well-defined process ensures avoiding classic errors and improving the chances of the overall predictive modeling. The process starts with collecting data into a data warehouse or a data lake, studying and transforming data to make it ready for modeling, and then designing predictive features which can fit to a model after trying several algorithms, which we are going to discuss. Once the model is ready, based on different metrics, the model needs to be deployed in production. And I'm going to, in the next couple of slides, I'm going to discuss the data cleaning, exploration, and feature engineering in detail. But before that, something which is important to highlight here is that for any successful models to be built, and that is even more relevant into lending business, a very strong domain knowledge is very important, right? So the data scientists over time must understand the overall business context, the constraints in which they are operating, and the customer segments really well. Also, the kind of modeling approach or problem statement one is using in case of MSME lending is important to be defined earlier in the process. So, starting with the data preparation, right? In the real world, data is messy. Just to give you some examples, data might be inaccurate. So assume a person having two Aadhaar or social security number in your data, city name or pin code being incorrect. It could be non-uniform. So a variable like weight might be recorded in pounds or kilos in your database. There could be inconsistency. Customer might be having two existing residence addresses in your database, or it could be incomplete. So for a certain customer's age might be missing, but though it's a required field in your model. So there are ways to deal with all of this, and this is an important exercise in the machine learning pipeline, where the data scientist tries to understand the data, studies the data, and then clears the data. The other challenge which comes is the missing data. So for a lot of fields, you might not have any data at all, and there you need to impute data to use those kind of fields or variables into your modeling approach. If the information is missing for most of the variables, then it is suggested that you rather drop that particular variable. Continuing with the data preparation, sometimes the variables have to be transformed. So for example, a date might be saved in your database into different formats. So this has to be transformed. A string like male and female can be converted into values like 1 and 2, because then machine learning algorithms perform better. Also, a lot of strings might have to be normalized. So basically, if you're running an NLP kind of an experiment, then bringing the words to its root format is better. So for example, words like wording, words, word would all become word in that particular approach. A lot of derived variables might be created. So you might have only IP addresses, but from that IP addresses you might be able to create a variable of country. Also, this is an important step, feature value rescaling in the machine learning. It is also called as normalization. Since the range of values of raw data varies widely, objective functions will not work properly without normalization. For example, the majority of classifiers would look at the distance from the mean value. So in that case, it helps that the feature has been normalized between the value of 0 to 1. Moving quickly to my next slide, which is the data exploration. It is also called as exploratory data analysis, or EDA. So data exploration and data preparation is an iterative process, and it goes back and forth, right? The data scientist needs to understand the meaning of various fields, the range of values, understand the attributes in detail, so that he knows the limitations and the context of the data, right? It includes running some descriptive statistics on the data, like the head, top n values, the bottom n values of the data, what is the mean, median, mode, min, maximum, right? And it helps us identify in and creating the different bins for these data points, which can be used into our modeling approach. Further into data exploration, we can also draw graphs like scatter plots, which helps us visualize correlation or pattern between different set of variables, and it gives us new insight to the data scientist into the data format. There are certain correlations that have to be studied, and if the two variables are very correlated in nature, then one of these variables has to be dropped. There are approaches around clustering and visualization, which is important, which I'm going to discuss in my future slides as well. So coming to feature engineering, and I think this is the most fundamental of data science algorithms. Whenever we are building a model, what we are trying to build is we are trying to define certain predictive features and fit an equation or a model to it, which can give us the required output or variable. And feature engineering, after once we have explored the data, prepared the data, is a creative as well as a very skilled data science exercise, because it requires creating a lot of variables or features which might not exist directly in the data. It also requires a good amount of domain knowledge to come up with the right kind of features. So the best features may be a subset or a combination or a transform version of the features, and they might be computers using combination of different variables. So just to give an example, if I have in a lending business, if I have to come up with a feature of debt to income, I might be using his total liabilities from the bureau data, and I might be using his income from the banking and financial data and developing a new feature out of it. During the feature engineering, data scientists tried multiple features and check for predictive value in the data. Other than domain knowledge, creativity is also required during this step. And there are certain algorithms like random forest which support extracting different combination of features. So if we select just one combination of features, we might lose some information, but algorithms like random forest help us test the different set of features combination in building a predictive model. There is an algorithm called PCA, or Principal Component Analysis, which is primarily used for damage reduction, right? So if in a multivariate feature set, PCA helps you visualize the overall space in just using 2 or 3 features, and help you avoid the overfitting in the model. So next, we can discuss some of the popular ML algorithms used in digital lending. Logistic regression is one. Basically, the central premise of logistic regression is that you can divide your input space into 2 nice regions. It's a classification algorithm, and it acts as a linear equation between your 2 classification labels. There is a decision tree, which is like a conceptual tree where the top of the tree takes an input, and after traversing the tree, you get your outcome, which is again the classification output. The random forest, as we discussed, is primarily combines the input of the lot of other decision trees and reduce the dependence on the single set of features. There is an algorithm called KNN, or nearest neighbor algorithm, which is which is basically what KNN means is, just to give you an example, if there is a cluster of the bad customers and there is a new loan applicant where most of the attributes are matching the bad customer attributes, then he will be labeled as a bad customer. There is neural networks, which is a bit advanced algorithm, but it can be used when either you have a lot of large you have non-linear relationships between the data. And then there are certain unsupervised learning approaches. By unsupervised learning, I mean where you do not have the necessary labeled data. So you are doing certain pattern finding, or you're trying to study the data to develop new trends. So K-means clustering, which is primarily what we discussed for developing some new customer segments or customizing your offers for them. We can do a K-means clustering exercise. The way it works is K-means clustering tries to partition the overall sample of the data into some particular clusters which have where most of the data points have the lowest distance from the mean. And then there is principal component analysis, which we discussed in the earlier slides. So to it, what are the challenges in applying machine learning or data gathering in applying machine learning algorithms? And this is where I think we need to understand why there's a lot of buzz, but a lot of there's not much action in the ground, because of a lot of people miss on these challenges. First of all, day one, right? If you are starting as a digital lender, you have to acquire this data at cost and over time. You do not have data on the day one for your customer segment to build any kind of models. The other challenge is that your data will always be lagging your business demands. As you scale up, you will always require new customer segments, new kind of credit algorithms for different kind of customer base, but you won't have enough data to build that particular kind of insight. The data might be poor because data gets collected from multiple sources, right? Sometimes you're also using data generated by other lenders. For example, if I'm using transactional data in the bank, that is coming from some other third-party bank. If I'm using the credit bureau data, that data has been reported to the credit bureau by some third-party bank or NBFC, and their systems might not be strong enough to report it properly. So you might got false data at the source, and you have to deal with it. The data might be imbalanced. So as a lender, every good lender faces this problem that only 5% or 10% of your customers might be labeled as bad because they are the ones who have defaulted. Rest 95-96% of the customers are always good, right? So if you're trying to run any classification algorithm to segment this customer and to build a predictive model, your one of your labels out of the two is highly skewed. So again, there are approaches to deal with it. Then a lot of unstructured data requires a lot of specialized skills like NLP and speech recognition to deal with voice data, which is further difficult to find, right? And then there are privacy concerns. So recently SMS data has been stopped by Google as the policy. So you need to be aware of how you are storing this data, what kind of security you have built in your systems while using all of this alternate data. These were the challenges in applying ML in data gathering. There are a couple of challenges at the modeling front as well. One of the challenges that the training data might not be representative enough. So for example, if you have done your lending business only in a particular geography, and if you are scaling to 10 other geographies, your model might not generalize well because all the data that you have is not representative of the entire population. Overfitting is another problem to deal with because a data scientist would always go for developing more and more features, but that might lead to overfitting with the sample data on which the model has built. But that particular model might not generalize well in the production. Then the other challenge is that the data side may be too small to build a good model. So for example, typically for a lending business, you need at least 10,000 samples of data to build a meaningful model. And that that data should also be labeled over time. So collecting this amount of data becomes a challenge, and it only comes with time. And the feedback loop is slower. Since you are doing loans for 2-3 years, till the very end, you won't be sure that the overall portfolio quality or the loan quality was good or not. So this leads to making the feedback loop slower. In some of the other algorithms like recommendation, which companies like Amazon or Netflix are using, their feedback loop is very short. But in the lending business, it's always on a higher side. The other are the human challenges in applying ML. Data science is a very niche skill, and then when you further require people to come from certain kind of domain experience, it's further hard to find good people. Also, a lot of these algorithms might be black box algorithms, which the business people in the credit, in your sales team might not be able to understand. And this leads to a lot of gaps between your data science and business teams. So one way of doing it is that you try simpler algorithms like logistic regression, decision tree, which can be explained to most of the other stakeholders, and also try to get your business team involved in the process at a very early stage. Also, very small mistakes into your data science modeling, which can be human errors. For example, just a miscalculation of any miscalculation or any error while deploying a model can lead to a very different results. So checking it and rechecking it is very important whenever you are running your entire data science pipeline. Having few people who can question the data from different perspectives is helpful. So at last, what I would like to conclude is there are multiple lenders in the startup space, in the lending space, and they are using several ML approaches. We know that it has become more of a buzzword, but still, I would advocate that it makes sense to invest into ML and your data infrastructure, as over time only this could solve for reducing the NPAs, OPEX and TAT for the digital lenders.
Thank you, Shalabh. So there's a lot of information for all of us to look at and understand as well. So I see your presentation as in the two parts mainly. You've described the lending business, and then you've described the digital transformation, giving lots of stuff on machine learning itself. So let me go very quickly for most of the listeners today are actually charter holders, so they are likely from the business side and may not have an understanding on technology side. So could you walk us through quickly on a use case? For example, let's say take a retailer who's approached you, and the retailer, she wants a small loan of 5 lakh rupees.
Right.
How will ML machine learning, and how will you solve that problem? Can you identify, in very quick answer, please, if you can identify the modeling that you would do, the clustering that you would do using ML, and what are the human errors that could come into this? If you can walk through very quickly.
Sure. So very good example. Traders or small grocery stores is a very large segment of micro businesses in India, and they are the kind of typical businesses which do not get loans from the traditional segments because they do not have any financial documents in place. So now the problem is that in absence of any P&L financials, what are the data points that you can use to underwrite these customers? Because the first use case is determining whether it's going to be a good customer or a bad customer. So what you have in your hand is a small amount of credit data. He might might have few unsecured loans like credit card, two-wheeler loan, or something of this sort. That customer might have some amount of transactional data, right? So first of all, this data needs to be collected for a certain set of businesses in the trading segment. As I said, you have to on the day one you do not have any data. So initially you will create certain hypothesis that I will use these variables. So for example, I will use his cash deposit on a monthly basis, or his credit transactions in his bank account as one of the variables, the kind of loan inquiries that he has been making in the past, which is available from the CIBIL, as one of the variables, his demographic data, for example, how long he has been running this particular shop, what is his education level, who are his dependents. So these all variables initially you would create basis on your domain knowledge. You would give loans, might be small ticket loans, to some 500,000 odd customers, and over time you would have performance of these businesses on these loans, and then you would deploy your machine learning models on this particular data and find out which were the features which are helping in predicting its creditworthiness, which particular variables are not helping in creditworthiness, and what are the variables which we missed. Maybe there is some information which I collected. For example, if this customer talked to my sales team 10 times and he expressed certain information which is not captured in my systems otherwise, can I use that information from next time going forward in underwriting a customer if it comes as a highly predictive variable? So the key point that I would like to highlight here is that everyone has to invest in collecting data after identifying a segment, and once you have the historical data and their performance, then you try to build those models into it. Right? On day one, you won't have a machine learning model.
Yeah. So how many variables are we talking about, Shalabh? Is it 10 variables, 100 variables, 1,000 variables? So I wanted to see if you can demonstrate the power of machine learning.
Yeah. So just to give an example, at Ziploan, we use close to 170 variables, but variables might range between 20 to 100 to 1,000. When you're dealing with a number of variables, your approach of machine learning, so whether you would like to use a classification algorithm like logistic regression or an advanced algorithm like deep learning, depends on the kind of number of features that you are trying to use. But it all depends on how many data sources you are able to leverage and the kind of complexity you want to build in your model. Generally, it is preferred that you use a smaller number of variables to build.
Thank you. So can we move slightly to the business side of things? How do you determine the credit worthiness of a person? What is it from the CFA program curriculum or your own learnings that you have used to create a model for determining credit worthiness? A 20-second, 30-second answer is also okay, because we've got lots of questions and running out of time.
Sure. So in our case, what we have focused more on is the financial discipline of the customer, because these were lacking the past credit history as well. So we focused on his banking behavior, on his utility payment behavior. So if he's not bouncing on his payments in his banking, if he's depositing his other utility bills like electricity, water bills on time, and if there is certain stability in his demographics, as in staying in a particular property over time, we have found out that you actually don't require a lot of financial documents in that case, and you can build a sound model on these kind of variables.
So how can a digital MSME lender identify new customer segments using machine learning? What kind of databases from institutions can be used? Very quick answer, Shalabh, if possible.
Yeah, so this is primarily a clustering problem. So what I'll just explain. This is the core of what we are trying to do. When we initially build an hypothesis basis on certain variables, or we build a initial scoring model. Let's say we are rejecting 85% of the customers that are coming to us, and only 15% are getting a loan. Now, the 85 that have been rejected, then over time, if we have even not disbursed the loan, we try to go back to the credit bureau and take their scrub. These are certain information variables. So what happened after we rejected the loan, after 1 year, after 1.5 years, and see what was his trend, and then try to determine how many of those customers turned out to be eventually good on any other loans that they took, or turned out to be bad, right? And then use this data to label it as good or bad, and again run clustering algorithm. So every time you have to open a new customer segment, you have to get their data from other third-party source, how they interacted on some particular base. Is it clear?
Yes, somewhat clear, but I'm sure there'll be follow-up questions, so we'll come back to you. I've got two more questions here, before we, there's many more, but I've just picked two. What has been the default rate for you, and can you give very quickly a machine learning use case where it has failed, where machine learning has failed?
Where machine learning has
failed.
Okay. Yeah. So the default rate for us, Srinivas, currently stands at 1.8%. We have disbursed close to 180 crore worth in loans. As per the industry segment, this is a good sort of asset quality. On the use case where machine learning has failed in a lot of places initially, but over time, with the right kind of investment, we have been able to achieve a lot of success in several projects we did, right? So the first failure for us was we actually tried to study all the banking transactional data basis on the machine learning algorithms, and the accuracy was very poor. Over 1 year, as the data size grew and our understanding, we have been able to achieve accuracy of more than 93%. So this is what I would like to say. Initially it fails, but with a consistent sort of investment into data and the understanding of the data, your chances of success improves.
Right. And just wanted to understand how many people you employ, what are the opportunities for charter holders? Or those who have taken the stake.
So Srinivas, like the overall company size is close to 200 right now. We have a 30-member technology and data science team, and we are hiring for strategy and operations, finance, also data science positions. So happy to look at the profiles and happy to interact with the other charter holders on this.
Very nice. Thank you very much, Shalabh. Thank you very much, listeners, for dialing in today. We have got another good webinar coming up on February 14th. The CEO of Edelweiss is Edelweiss. What is the name of the exact name of the company? So Radhika Gupta is going to talk on how to create. How to think about startups and how to create a startup plan. Radhika Gupta, she is the CEO of Edelweiss Asset Management Limited. Don't miss that webinar on 14th Feb. Thank you again, Shalabh. Thank you again, listeners, for listening in.
Yeah, thanks, Srinivas, and thanks everyone for joining for this call.